Are you one of those people who hate speaking in front of audiences? Would you like to enhance your communication and leadership skills? Then consider joining the Wrightwood-Ashburn Overcomers Toastmasters Club. Our club will help you conquer your fear of public speaking and teach you how to deliver messages that will win others over. Many times our jobs require us to speak in front of audiences to give PowerPoint presentations. If that's you, we invite you to join us, the Wrightwood-Ashburn Overcomers Toastmasters Club, every second and fourth Saturday between 10:30 a.m. and 12:30 p.m. Central Standard Time. Come join us online at WAO.toastmasterclubs.org. Then check out upcoming WAO events.
Good evening and welcome to another episode of We Are Overcomers, the Wrightwood-Ashburn Overcomers podcast. For this episode, I'm your host. My name is Calvin Gibbs. And today we have a topic that is very important to us as individuals, as people, and as business owners as well. I have a very special guest in the studio with me this evening. His name is L. Darnell Williams, and he is a member of the Wrightwood-Ashburn Overcomers Toastmasters Club, also known as WAO. L. Darnell, welcome to the show.
Thank you very much for having me. I'm glad to be here.
All right. Well, let's get right into it. I'm going to, I guess I should properly introduce you. L. Darnell Williams is the CEO of L. Darnell's Insights, LLC. L. Darnell, please tell us a little bit about your company and what you do.
What we do at L. Darnell's Insights is provide people with insight to themselves in many areas, relationship building and credit, and pretty much trying to get people to know themselves on a higher level so that they can achieve significant goals and know what it's like to win. So we more or less focus on personal and business development. And that's why I enjoy the topic we're going to talk about today, because it has to do with us personally. And if you own a business, it could have something to do with you there also.
Okay, sounds good. Now, did you go to school for this subject? How did you learn this area of expertise?
I actually started out, I have a Bachelor of Science degree in finance. I got in Northern Illinois because I always knew I wanted to do some coaching on some level. And I always knew that many, if not all decisions that we make in life generally comes down to a financial thought, a financial idea. Can I afford it? Am I able to obtain what I'm trying to obtain? So I got my degree in finance, and then I had some business problems that came up for me. And again, I wanted to better myself. So I went back and got my MBA at Lake Forest in management, because if I was going to work with other people, I need to know how to manage myself along with being able to help manage others.
Okay, that makes sense. That makes a lot of sense. And of course, it all comes down to, as you said, most problems can be solved, or most problems are a result of money, either not managing it well or just not having it at all. So in your company, do you help people get loans or credit, or do you, what do you do with it?
The objective mainly is with us is we want to personally develop people, meaning we want to raise their awareness level so that they have insight as to who they are. I mean, once you know, love, and trust yourself, all your decisions after that will tend to be better because you're comfortable with who you're working with, which is yourself. credit happens to be one of the areas that we work in because that's something that affects us all the way around. We also work in the area of relationship building, and more importantly, getting people to establish his businesses the right way, develop things the right way. And it all starts with each and every one of us knowing ourselves, and then from that point, being able to position ourselves to win in every area that we can.
So would you say this is a more holistic approach to?
It's holistic in the sense that we want you to begin to think more, of course, put yourself first, and really not be bogged down by the worry, fear, and doubt that you're going to get from everyone else if you're not comfortable with who you are. So I believe that, and what has happened for me is I've been able to encourage people to step up and really move toward the goals that they have, really move toward achieving something, and more or less being able to stack wins until you get to a point of no return, so to speak.
Okay, I like that. Stack wins until you get to the point of no return, where you can't be stopped, huh?
Absolutely.
I like that. I like that. So let's get into the area of, well, let's break it down. I know you have something to tell us about business credit awareness, but let's start with the personal credit awareness. You know, let's say I don't have good credit, okay? What signifies I don't have good credit as far as the rating, and how can I go about making that better?
Well, generally what happens is most of us really never know about our credit report because they really don't teach it expansively in the school system. So generally what happens is people run into a problem if they're going to go and try to get a car. They either have no credit or bad credit, and that's their first introduction to that particular area. So one thing you want to focus on is knowing about your credit score, and that ranges from 300 to 850. 300 on the low end, which means you have very bad credit, up to 850, where it's considered excellent. You get the lower rates whenever you buy anything. And what happens is the credit industry has pretty much, I guess, brainwashed people into thinking that their credit really controls them. And really what happens is you can control your own credit. And that's the reason I try to give people insight as to how to do that so that they can have a better chance of being able to achieve things in life. So as I mentioned, you have scores that range from like 300 to 619. And I actually have higher ranges, so to speak, because I'm trying to encourage people to shoot for the highest score. But that's considered to be poor credit up to 619. Anything between 620 and 680 is fair. And you don't start getting good until you have over a 680 credit report. 680 to 749, you're good. And then you're excellent, of course, if you have great credit. Again, meaning you will get the best rates, the lowest interest rates when you buy something, and you have a lot more purchasing power the higher your credit score is.
Now, what is the highest personal credit score rating?
It's 850. 850 is the highest you can get. And it's not necessarily that you should have that higher score or you need to have that higher score because it's really hard to get there. Right. And even people with an 850 credit score can be turned down. Just because you have a high credit score doesn't mean you can't be turned down. You can be turned down because your credit mix isn't right. So there's other factors that come into play way more important than the credit score.
Credit mix. That's interesting. We're going to put a pin in that. I want to ask you more about the credit mix later on. But you mentioned that it's not taught in schools. Is this something that should be taught in school?
Honestly, I believe if they taught people about credit in the early years, and even in the schools, they don't teach you about checking accounts or any of the key factors that you're going to deal with once you complete your high school education and you're going to go to college. If we had this information up front, I believe it would put people in a better situation to think of their future. They'll know what's going to impact them. If they got the information, it will put them in a better position to speak with their parents about how they're going to approach their life from a credit standpoint. And that's really the main objective I believe people would gain out of it. It will give you more confidence and literally empower a youngster more to know that they do have the ability to control their life from a credit standpoint.
Okay. That's very interesting to me. Should it be taught in school, like in elementary schools, high schools, or should you just get introduced to it in college when you got to start paying bills?
I believe in high school would be the perfect place because, again, it would give those students the insight, as I always talk about insight, to what they can do. They become familiar with things such as the credit report and the credit agencies that are available. One thing I wanted to mention is that, a lot of times people aren't really familiar with who's doing all this reporting and how it comes about. And that's something that if youngsters learned at an early age, it again would position them to know more, be more, and have more because of their increased understanding of the subject area.
Okay. Would you say that there's a divide in people's knowledge of this subject that might run either culturally or racially?
I believe it really has a tremendous impact on people who are in underserved communities, so to speak, minorities, because since it's not taught in schools, a lot of times we're not introduced to any of these concepts unless you stumble upon it, say on a YouTube, or you hear about other people talking about it. And even then, they're talking about it from a standpoint of lack of knowledge, lack of awareness, and not really knowing what impact it really has on them. So I believe, more importantly, in the area, for example, African Americans, we really don't have the full realm of the area. So by not knowing that, we wouldn't even be familiar with the whole idea that there really aren't any bureau. When you hear the word bureau, what do you think of?
I think of TransUnion, Equifax, maybe.
Oh, again, because they have been perpetrated on us as bureaus. I think of the FBI when I hear bureau. You think it's a government agency or something of that nature, but really,
okay.
If you look at the law, and there is a law that everyone can look at, here's one of those knowledge points, the Fair Credit Reporting Act, which was put together by Congress, that measures how consumer reporting agencies have to handle our information. And if you look at one of the areas, which is Law 15 USC 1681, it literally lays out what consumer reporting agencies are allowed to do. And they have to be accurate. They have to have permission from you to share their information. And they have to be able to verify it. And if you look at that law, you will never see the word credit bureau anywhere.
That is very interesting. So in your opinion, or what you just told us, credit bureaus, just by definition, is inaccurate.
Very inaccurate in the sense that these are publicly traded companies, your TransUnions, your Equifax, and Experian. They're actually companies that sell our information to the bank. But ironically, here's another thought. Most people don't even know that there are sub-bureaus that collect your data. And then they sell it to the big three. And some of those companies would be Innovis, SageScreen, and LexisNexis. And those agencies, they collect your data, they sell it to the bureaus turn around and they sell it to the bank. So anytime you get a hard pull on your credit report, and we'll get into that when we talk about inquiries, when you get a hard pull on your credit report, know that that institution had to pay to get your information.
Wow, that's interesting. I never knew that. Now, I've heard of LexisNexis. I've heard of that before. Those other subdivisions are my first time hearing of them. I didn't even know that they existed or they were a thing. So that's very, very interesting to me. Now, this I know through some personal situations I had to go through. The information from the big three, Equifax, TransUnion, and Experian, I believe it is, could they have different information on any individual at any given time?
One thing is that all the reporting agencies are going to be slightly different. They all are measuring your score based on your data. In fact, most people think that it's all your credit, everything that you've done from a credit standpoint. But if you look at the top of your credit report, and here's a lot of times what happens is that you're rejected based on the personal information on the credit report, right at the top. They haven't even looked at any of your data. You could have a 750 score. But let's say, for example, your personal information at the top says you got 2 or 3 different names, 2 or 3 different addresses, things are outdated, you're not aware, they'll turn you down there because they really can't decipher who you are and where you live because there's so much convoluted information at the top of a report. And that would be the first step I would suggest to someone to do is clean up the very first portion, which is your profile of your credit report, and that'll help you give you a leg up right from the beginning.
That's interesting. That sounds like very good advice as well. Back to that information that they get from the sub companies, even if I had 2 or 3 addresses and I moved quite a bit in, let's say, a given period of time, the payment of bills schedule, they should all be the same, right?
They should be, but then again, too, it's who are TransUnion or Equifax or experiencing getting their information from. You know, one may be getting it from LexisNexis. Someone may be getting it from SageStream. They're all going to have different information because their way of collecting data is different. See, so it's incumbent upon a person to keep track of their credit report, look at it on a regular basis, but also realize, and I'm going to really implore everyone to go to the Fair Credit Reporting Act, look at it and read it with a discerning eye to come up with or become aware of knowing that, number one, these are credit reporting agencies. They literally should get your permission before they share any of this information with others. It's all right there in the law. But since no one knows the law, people are being pushed around and jerked around however they can be, the big 3, because they are actual businesses that are trying to make money.
Wow. Wow, that's some good stuff there. Who knew? And if people don't know, they can get really royally screwed around.
And that's generally what happens.
Wow. Okay, well, let's talk a little bit more about the credit mix. What, by definition, what is the credit mix?
Now, the credit mix is essentially when you are having your credit score developed, they look at main areas. One of the biggest areas and what's measured the most is your credit cards. That shows how you spend money on a day-to-day basis. It shows how you pay your bills on a regular basis. Let's say if all you had were credit cards, that would probably be considered not having a good credit mix because they want you to have credit cards. But in addition to credit cards, they want to see, were you able to handle an installment loan? Have you ever had a car loan? Have you ever had a mortgage? See, these things go into the overall mix of your credit, and it gives you a leg up if you happen to have done business in all those areas. But the biggest measuring stick is the utilization of your credit card. You can get a new loan. It may affect your score maybe 1 or 2 points, but it'll bounce back. Whereas if you have missed payments with a credit card, it can affect you tremendously just because you missed that payment. And it shows that you're not responsible.
All right. So let me give you a scenario. Let's say I am a young Calvin Gibbs. I'm 25 years old, let's say, fresh out of college, working my first job, and I want to get a new car. I have one credit card that I don't use much. I do have a small balance on it. Let's say the credit limit, let's say it's $1,000. And maybe I've used $300 or $400 on it, but I paid more than the minimum that's due every month. I walk into a car dealership to get a car. They pull my credit, and there's a good chance that I'm going to get the loan for the car, but they're going to charge me a higher rate because I only have one credit card.
Absolutely. They're going to charge you a higher rate. But of course, if I was working with you, you would never, absolutely never be in a car dealership. The reason being is because all these businesses are in business to make money.
Right.
And if you go directly to a car dealership, what they're going to do is look for the rate that you're going to be able to afford. So they may hit your credit report with several inquiries, which again hurts your credit score. It helps them because they're going to get you to get into that car at a higher interest rate because you have low to no credit. I would definitely have you get away from those places and direct you towards your bank, probably more importantly, maybe even a credit union.
Uh-huh.
Have them come up with an amount that you would be able to borrow and then go shopping for the car.
And then
because now what you've done is you position yourself to be working with someone you have a relationship with. You've gotten them to give you a general idea of how much they will loan you. And now it gives you a hand up when you go to the dealership because you know what you can spend, you know where you're getting your money from, and you know you have a lot better rate than they would ever give you.
Okay, I got a little secret I'm going to tell here. Full disclosure. I used to be a used car salesman here in here in Illinois. And I kind of knew the answer to that one, how patrons are treated differently when they come in with their check from their credit union or their bank.
Yeah.
As opposed to getting the loan through the car dealership. It's a big difference as to how they are treated. And,
absolutely.
And what you said is absolutely correct. So the key advice there is if you can, try to avoid those dealerships like that or anybody that's going to pull your credit, charge you a higher rate unjustly in a lot of cases. Try to work with a credit union or your bank, build a relationship with them, and you'll come out much better.
Absolutely.
Absolutely. Okay, cool. That's good stuff there. Thank you, sir. Good stuff. Now let's talk about the personal credit. Some of the factors we did talk about: the payment history. That was one. Credit.
Yeah, if I could, let me cover a few of those just because a lot of people misunderstand some of those. And one, like you say, payment history, and that's like 35% of your score.
Mm-hmm.
And all that is how do you pay your bills on a monthly basis? As I mentioned before, if you miss one payment, that's going to affect your payment history. And that's 35% of your score. So you can see how just that one thing could affect your score. The next thing is utilization rate. Credit utilization rate, again, as I mentioned before, with the credit cards is how you're really measured in developing your credit report. And you want to keep your utilization rate under 30%, preferably 10% if you can. And that actually gives you the better rates. It shows that you're able to handle credit. And by using a small amount, it gives an institution the whole idea that this person can handle the money. We can give them more money to work with because they've demonstrated through keeping a low utilization rate. That means they already always have room to work with from a credit standpoint. But then when you look at credit history, which is 15%, that actually is how long you've had credit.
Mm-hmm.
So if you have 10 years of credit history, you are in a better position with someone who only has 2 or 3 years of credit history because they're going to be looked at differently because they have not established a long history.
Right.
And what happens is they'll hit you for that because anytime you get a new credit card, it lowers your credit history because they divide the latest card you had by the years you had it. So anytime you get a new card now, it brings down your credit history. So again, that is another thing to really pay close attention to.
Okay. And then of course, the other factor was the credit mix, which we talked about.
And then inquiry. Yeah. Like the car dealership, they'll put a bunch of inquiries trying to sort through the people that their lenders are to come up with the one that's going to work with you. They're not concerned about you having inquiries on your credit report. But one thing you could do is if you cite that and you have several inquiries on your report due to going to a dealership, you'll have an easier time having them removed.
Got it. Okay. Makes sense. Makes sense. So what will improve your credit score?
You can really improve your credit score by one, knowing what your credit report has on it, being really willing to take measures to correct things like the personal information. And anytime you miss payments or what have you, be willing to figure out what you can do, who you can talk to maybe have a late payment removed. If you do it in a timely manner, the institution that you're working with, they'll be willing to remove it because they can look at your credit report and see that you haven't failed in the past. You just happen to have a glitch in life and you had to make a decision. Another way to really improve your credit report is to know your FICO score. Your FICO score is by Verizon Corporation, and what they do is they actually do the measuring and explaining to people about how they come up with the scores. And this is what the credit bureaus use. But there's several different FICO scores. FICO 8 is used for autos and credit cards, but FICO 2, 3, 4, and 5 are literally used for mortgages. So having that knowledge on the front end gives you a leg up. Another nice tool that if you're with trustworthy people, a trustworthy family member, there's a concept called piggybacking. And that is where you can get someone to get you to be an authorized user on their card. You don't even have to have the card. But what happens is they add that history of that card to your credit report. So one of the reasons people might do it, let's say you had several credit cards, but your utilization rate was around 60%, which of course, as we know, is very high. But what happens is let's say you had a brother or someone who had a credit card that had $30,000 worth of credit on it, but they only used $2,000 or $3,000. By adding that to your credit report, it immediately lowers your credit utilization rate. And if they've had it for a long time, it immediately adds years to your credit report, therefore driving your credit score up tremendously because you added those two dynamics to your credit score.
Wow. And I guarantee you, I bet you a lot of people don't even know about that.
No, they don't know, and it's not taught. And it's very important that we have conversations like this because it gives people a chance. Hey, you can't teach everybody anything in 30, 40 minutes, but if you could just raise their awareness level, that's really the key, because then yourself will tell you, let me look into that.
Okay. Wow, this has been some very interesting information, El Darnell. Let's take a little break right here. And when we come back, we're going to move forward, but we're going to talk about credit from the business point of view.
Sounds great. Thanks.
All right. Only on We Are Overcomers podcast. We'll be right back after this short commercial.
If you are a college student looking for your identity, an entrepreneur looking to expand your streams of revenue, or a small business owner wanting to scale up, build a relationship with L. Darnell's Insights, LLC. At LDI, they will combine your beliefs with wealth awareness methods in order to elevate your self-worth, with the end result being your goals accomplishment. Let's build a relationship. Set up an appointment at ldarnellsinsights.com. That's ldarnells with an S, insights with an S.com.
And we are back. This is We Are Overcomers podcast, the Wrightwood-Ashburn Overcomers podcast, and I'm your host, Calvin Gibbs. Today, my guest is L. Darnell Williams and he's the CEO of L. Darnell's Insights, LLC. We just got some fantastic information on personal credit awareness, and now we're going to move into developing strong business credit. So, L. Darnell, first question that I have for you is, should a person keep their business credit separate from their personal credit, and why?
Well, that's a great question. And the appropriate answer for that question is yes, you absolutely should keep the two separated. This is why you set up a separate entity like an LLC or a corporation for that express purpose of keeping them separate. The beauty of personal credit, and that's why you have to have really strong personal credit, because it can go a long way insofar as helping you to build a foundation of using other people's money as business. Institutions, banks, credit unions, and the like are always interested in helping a business grow, but it's all going to be driven by having great personal credit, because you're going to have to personally guarantee that you're going to be able to carry the load in the event the company runs into a situation.
Okay. So as far as business credit, are the ranges the same as personal credit?
They actually are a lot different. With the credit for business, you are more or less looking at being able to go in and establish various companies. For example, net 30s, you want to start a few net 30 companies, go to these companies because there's quite a few of them like Granger and what have you that will allow you to set up accounts with them. Things that you're going to use in the business, they will give you your initial credit going in, and sometimes they'll use a personal guarantor, but in some cases they don't. The reason that you want to do that is you want to have a credit rating established for the company, and that range goes from 1 to 100, with higher scores of 80 or more being the measuring stick. Once you start dropping below 50 and 60%, you're frowned upon because you're not a good credit risk. Again, there are various credit bureaus that monitor business, and those bureaus are Dun & Bradstreet, Equifax, and also Experian. But they carry totally different reports, and they also are monitoring the business, not so much to see if the business is totally using their credit or using whatever amount of their credit. They're there to make sure that pay your bills on time. If you pay your bills on time as a business, you'll probably never go wrong, especially the more credit you get, the more you're able to get, because they see that you're able to manage other people's money, which is really what it is.
Okay. So TransUnion has nothing to do with business credit.
Absolutely not. In fact, what you need to find out when you actually are going to establish business credit is find out who do they report to. Do they report to Experian? Do they report to Equifax? Or do they report to Dun & Bradstreet? Because what you want to do as a business is build as many kind of like interest points of people who've done business with you. And you're measured based on the number of actual credit lines that you have created as you begin to start your business.
Okay. Now, as far as business credit, you mentioned about payment history. Are there any other credit factors that apply just for businesses?
Yeah, now they do have payment history, like I mentioned. You want to make sure you pay your bills on time because that's going to measure.
Right.
But then they also have age of credit history. Again, how many different companies have you dealt with? How many different creditors have you built up? And again, they look at credit usage, but they don't penalize you for utilization of credit as they would with your personal credit. As I mentioned, with personal credit, you really want to stay under 30% utilization, and that's of your credit cards. Whereas with a business, you literally could use the credit card to the hilt. Say $1,000 card, you could use it up to say $950. They're not concerned as long as you make the payments. They know businesses are going to have up and down times, and they know businesses are going to run into problems. So they're willing to allow you to utilize the funds. But again, too, their main interest is how quickly and when can you pay the money back.
But they know it takes money. It takes money to make money, right?
Absolutely. And they're allowing you to use their money. You just want to make sure you use it to invest and grow.
Okay. Now, I know also from my time in commercial insurance, there's also a, for lack of a better word, it's like a risk category. depending
Yes.
on what industry you might be in?
Exactly. There's an industry risk. Companies like financial institutions are high risk, real estate's high risk. If you're looking at low risk, you want to be somewhere in the area of marketing or e-stores or something of that nature that's low risk. Because again, they're going to measure you on the riskiness of your business. So if you're going in there saying, hey, I'm going to be teaching people how to borrow money or what have you, a bank may frown upon that. Number one, because you're in the business competing against them. But then also, they don't really want to deal with other financial institutions because they're not really sure what you're directing or telling people to do.
Okay.
So the main objective there is to find a business, and you can do that just by coming up with your SIC number or
Right.
NAICS number.
Right.
And that you can go there, find the industry where you're going to have as little risk as possible.
Okay. So it makes sense. It makes sense. And of course, there's the size of your business too, right?
Absolutely.
So the bigger you are.
Yeah, the bigger you are, probably the more likely. And of course, the more credit you have. But even a small LLC could go out and get quite a bit of business credit. It's just a matter of, are they set up from a personal standpoint? And if you are, you literally can go out and get $50,000 to $150,000 in a relatively short period of time.
And the bigger the company is, the bigger the risk in some cases?
In some cases, I think they mainly look at risk factor based on the industry that you're in. They're measuring it by that, because you could be a big company and still not know how to pay your bill.
Okay.
Which is ultimately going to bring you down.
Okay. Now, are there any benefits, let's say, are there any benefits to my company that
absolutely.
That
and I really love talking about the business side of things. Is because
I have good personal credit.
Yeah.
Could my business benefit from that?
Totally. Your business totally will benefit from that, because if you have excellent credit, and especially if you have credit cards, personal credit cards that have a high balance, or not high balance, but a high credit limit.
Okay.
The reason being is because when you go out and apply for business credit, one thing they'll do is they'll typically give you lines of credit and or credit cards that are 5 to 10 times your highest credit limit. Wow. So if you had a credit card that was $10,000, you would probably have a relatively easy time getting $50,000 to $100,000 from a financial institution that you build a strong relationship with, because you've already proved to them from the personal side that you're able to control or handle your money. So they're willing to give that to you because they want to see businesses grow. Business is what run America.
Okay. Earlier, we talked about keeping them separate, but there's a fine line where they do cross, or they can help each other.
Well, it helps. The reason I say it helps from a personal standpoint, because you want to have as good a credit as you can, since you're embarking upon this business.
Right.
But what happens is once you establish business credit, it does not report to the personal credit. A true benefit. Because let's say you were able to gain quite a bit of business credit and you were utilizing the business credit as much as you needed to keep your business running. The last concern you'll have is, are they going to report to my personal credit? And the answer is no. Now, there are some institutions like Capital One does it, and a few other institutions, and that's why it's important to find out whenever you're applying for credit, who do they report to, or do they report? More often than not, they won't even report at all. If they do, you want to make sure that they're reporting to the business credit agencies only.
Okay. Wow.
And then I was going to mention another benefit actually too also is that when you get the new business credit, more often than not, you may have, and I'm talking about credit cards or lines of credit, you may have a 0% interest for 12 to 18 months. That really gives you a tremendous start and a tremendous leg up when you're going into business, because it may take you a year to really get cash flow coming in, but hey, they're willing to help out businesses tremendously. I actually think everybody should own a business at some point in their life.
I do agree with that as well, especially, I mean, you get like 12 months to a year and a half with
Yeah,
0% financing. I mean, you can
exactly. So that allows you to use money, put it back, use it again. And as long as you're making money, hey, this is what financial institutions, credit unions, and different institutions of that nature, that's what they love. They want to see people be successful. They're putting you in a position to be successful, but you got to start with yourself to make sure that you're successful.
So in other words, the business credit reporting agencies, those three, DNB, Equifax, and Experian, are more concerned with the business willingness to pay the debt than how much debt the business uses.
Exactly. They're measured based on how they pay the bills,
Right.
not how they use the money.
Ah, okay.
And what's phenomenal is that if you establish good personal credit, you could build great business credit, and all that does is secure that you'll always have good personal credit.
Okay.
Because if, let's say, for example, if you got in trouble with a credit card on the personal side, again, this is all for educational purposes only. A person could do a balance transfer to one of the 0% credit cards. Therefore, it puts them back in good standing on their personal side, and they're getting that money at 0% and be able to pay the bill off through the business expenses. It's kind of like something that one of the tools that you get to use. But again, that's why I would say everything that I'm sharing is for educational purposes only.
Got it.
You know,
Got
people
it.
to come back and say, "Hey, man, well, he told me to go do this."
Now put that disclaimer in there. Put that disclaimer right in there.
Absolutely.
I didn't tell you to do it. It's for educational purposes only. Remember.
Absolutely.
I love it.
Everyone should do their own due diligence anyway.
That's true.
That's all we're trying to encourage. Grab the awareness, but then grow your own awareness.
Fantastic. Now, as far as business credit relationships, we talked about the banks, and I guess would credit unions be good and for businesses as well?
Absolutely. I believe credit unions are probably a better alternative to banks because they do give you the same product mix. They also are a little bit more lenient. But whether you're working with a bank or a credit union, you want to build a relationship. You don't go into someone on the first date and say, "Hey, let's get married." No, you go in, you're going to date them just as you would do with a financial institution. You want to set up a checking account, maybe set up a savings. Then you run some money through that account. Now you position yourself to go and ask them to allow you to utilize some of their money. And of course, once they make that decision, you've built a relationship, and you maintain that relationship by paying your bills on time and growing the relationship. Because if they were able to give you money and have you work with it in a great way, they will always be willing to give you more money. I don't know if you've ever heard, but if you got a lot of money, banks will work with you. If you have no money, they don't want to work with you at all.
Mm-hmm. Well, we see that the legal proceedings that's going on now,
Absolutely.
where a former president may have inflated his net worth to get more in loans from the banks, or better rates from the banks.
Absolutely.
But that's a topic for another show. So, Eldon, I want to thank you for your time, man. This has been some invaluable information. If someone wanted to reach you, where can they reach out to you at?
They can reach me at ldarnellsinsights.com, and that's L Darnells with an S, insights with an S.com. Or they can even call me at 312-327-3371, days from 9 to 5.
Okay, great. Fantastic. Well, for our mindfulness moment, we always like to do a mindfulness moment on We Are Overcomers podcast. I'm going to ask you to do it, a final thought for the listeners. If you had a piece of advice that you would give them about credit, personal and or business, what would that be? El Darnell, take it away.
I would like to share with everyone that you are the most important person in your life. You need to gain insight as to who you are, where you're going, and how you're going to get there, and learn how to work with and utilize other people's money. Banks are allowing you to do it. It is the lifeline of business. If you talk to any big business owner, they'll tell you that it's the credit that allowed them to get as big as they got. And just believe in yourself and keep stacking wins. You'll never lose.
All right. Well, thank you very much, El Darnell, for this great episode of We Are Overcomers podcast. I have been your host. My name is Calvin Gibbs, and we want to thank you for listening to this episode of We Are Overcomers podcast. When you see this on Spreaker.com, send us a message. Let us know how you like the episode, or maybe tell us what you would like to hear us discuss in the future. Okay, we would love to hear from you. We love feedback. We love evaluations. And we want to thank you again. And we will see you on the next episode of We Are Overcomers podcast.